Welcome to the deep dive. Today, we're going to tackle a sometimes tricky area, profit income.
Right.
We'll be looking at income from agriculture and forestry, commercial operations, and also self-employment.
Yeah, three big categories.
Think of this as your guide, really, to understanding the key differences between these income types. We're basing this on Dr. Youssefi's work, Part 2, Chapter 3.
It can seem a bit dense at first glance, definitely. But getting these distinctions down is, well, pretty crucial for understanding how different economic activities get treated financially.
Absolutely.
Our mission today is really just to pull out the most important bits for you, make it clear.
Okay, great. So let's start with that first one. Income from agriculture and forestry. That's Section 13 of the Income Tax Act, right? Broadly, what are we talking about here?
In essence, yeah, it's about the planned use of natural resources. Think soil, basically. Using it to produce plants and animals, and then, using or selling those products. That definition comes straight from the income tax regulations.
Yeah.
It's really about actively working with nature to generate goods.
Okay, so definitely more involved than just, like, having a few tomato plants in the backyard.
Oh, absolutely.
What specific kinds of income actually fall under this, then?
Well, there are several layers. First, you've got the income directly from the main activities, agriculture and forestry themselves. That's Section 13 again.
Right.
So agriculture means getting plants or parts of plants by using natural forces, growing grain, horticulture like fruit, veggies, tree nurseries, vineyards too.
Okay.
And forestry, well, that's getting forest products using natural forces, timber extraction, maybe some basic wood processing, that kind of thing.
Got it. So growing crops, harvesting timber. What about animals? Raising livestock?
Yep. Income from animal breeding and husbandry is in there too. But, and this is a big but, there's a condition. The number of animals you have can't go over a certain limit. It's worked out based on a ratio, your agricultural land size in hectares versus your livestock units. And there's an income cap too. 51,500 euros per financial year. That's in Section 13 in the regs.
Wow, specific.
It is. And for married couples filing jointly, those income limits are actually doubled. It's important because if your operation gets bigger than these limits...
It changes category.
Exactly. That excess part might well be seen as a commercial activity instead. Falls under a whole different section, Section 15.
So a really large-scale factory farm, say, might tip over into being classified differently.
Precisely that. If you consistently blow past those livestock density and income caps, the tax authorities will likely view that excess part as commercial animal breeding, income from commercial operations.
Okay, that makes sense. What else counts as agriculture and forestry income?
There's also income from other related uses. This is covered in Section 13 and also Section 62 of the Tax Act.
Like what?
Things like inland fishing, managing fish ponds, or fish farming, beekeeping.
Beekeeping, interesting.
Yeah, and transhumance that's moving livestock seasonally and even seed breeding. Plus, income specifically from hunting is also listed under Section 13, so it covers quite a range, all tied to the land and its resources.
Right. Now, Dr. Youssefi also brings up associated commercial operations. What are those exactly?
Okay, so these are basically side businesses that are meant to support the main farm or forestry operation. Good examples are like a dairy that's part of a farm, maybe a distillery if you're growing fruit, or a small sawmill attached to a forestry business.
Right, serving the main purpose.
Exactly. But there's a really key restriction here. The money you make from these side activities, the turnover, can't be more than 1/3 of the total turnover of the whole operation. The idea is it has to stay secondary. It shouldn't overshadow the main agricultural or forestry work.
That makes perfect sense. It supports the core business, doesn't become its own thing. We also see other agricultural and forestry use within Section 62 mentioned again. Is that just reminding us of those examples like fishing and beekeeping?
Pretty much, yeah. It's just reinforcing that those specific activities consistently fall into this category.
Yeah.
And Dr. Youssefi also briefly mentions subsidiary businesses used for agricultural and forestry purposes.
Okay. So how do the tax folks actually decide if an activity is agriculture or forestry? Is it like a checklist?
Not really a rigid checklist, no. It's more of an evaluation based on the overall picture in each specific case.
Right.
The income tax regulations really stress this holistic view. They look at everything together to figure out the primary nature of what's going on.
And for figuring out the profit for these farmers and foresters, do they just use the normal calendar year?
Generally, yeah, the profit calculation is tied to their financial year. If that financial year ends within a certain calendar year, the profit is usually assigned to that calendar year. That's Section 4A.
Okay.
If their financial year doesn't line up neatly with the calendar year, it gets a bit more complicated. The profit's often split proportionally.
Got it. Dr. Yousefi also mentioned something called production cessation rent. What is that?
Yeah, that's a specific type of income. It's linked to land and employment, mentioned in Section 13. It can be paid out if someone stops agricultural or forestry production as part of certain official programs.
So, like compensation for stopping farming.
Essentially, yes.
Sure.
Compensation for ceasing those specific activities.
Interesting. And there's also this exemption for farmers and foresters mentioned. Can you expand on that a bit?
Yes, under very specific conditions outlined in Section 13 and detailed by Dr. Yousefi, farmers and foresters might qualify for an income tax exemption. But it's tied to certain criteria and income limits that have to be met. It's not automatic.
Sounds like there are definitely some specific rules and potential breaks in this area. What about handling the risks? Farming's risky, right?
Yeah.
Crop failures, weather.
Absolutely. And until the 2022 tax year, there was a specific mechanism for that under Section 32C. It was called tariff smoothing.
Tariff smoothing.
Yeah. It was designed to help smooth out big swings in profit caused by things like, bad harvests, maybe due to climate change impacts. It basically lets you average things out a bit, tax-wise, reducing the hit in a really bad year by considering previous better years.
That sounds pretty helpful for a sector so exposed to the elements.
It was, yeah.
Lastly, on this section, Dr. Yousefi notes that forestry is regulated under a specific law.
That's right. They mentioned forestry falling under the law on the promotion of the termination of agricultural activity and its link to income tax liability. It's something discussed more later in the source. It likely contains specific rules, maybe support, for those ending forestry work.
Okay, that gives us a really solid picture of income from agriculture and forestry. Let's pivot now to the next big category, income from commercial operations. That's Section 15 of the Income Tax Act. What are the sort of defining features of a commercial enterprise?
Right. Section 15. According to the Act, and fleshed out in the regulations and guidelines, a commercial enterprise has, several key characteristics. It has to operate independently and sustainably, meaning, it's intended to be ongoing, not just a one-off. There has to be an intention to make a profit.
Profit motive, crucial.
Absolutely. It also needs to participate in general economic life, offering goods or services to, theoretically, anyone for a fee. And you're doing this at your own risk and expense.
Right.
And crucially, it can't be agriculture or forestry. It can't be freelance work, and it can't be other types of self-employment. So it's kind of the catch-all for ongoing business activity that doesn't fit neatly elsewhere.
So it's this broad swath of business activities that aren't farming or freelancing. What are the main types of income that fall under this commercial umbrella?
Dr. Yousefi highlights profits from sole proprietorships first. That's Section 15, number 1. This covers loads of common businesses, think craft businesses, retail shops, wholesale operations, manufacturing, commercial agents, brokers.
So the classic small business owner.
Pretty much.
Yeah.
And the key thing there is the income is attributed directly to the individual entrepreneur. They own it, they run it, they get the profit, they pay the tax.
Makes sense. Owner and business are tightly linked financially. But what if there are multiple owners, like in a partnership?
Okay, that brings us to the second main type.
Yeah.
Profits of partners from partnerships, also covered in Section 15.
Right.
This includes the income that comes from the partnership's commercial activity, where the partner operates at their own financial risk. But importantly, it's not just their share of the overall profit.
Oh, what else?
It also includes any other payments they get from the company, things like a salary for work they do for the partnership, or interest on a loan they might have given the company, or even rent if they own property the partnership uses.
So it's potentially more than just their slice of the final profit pie.
Exactly. And how that final profit gets divided up depends on the partnership agreement, or if there isn't one, on legal rules, like from the German Commercial Code. Dr. Yousefi gives a really good example of a general partnership, an OHG, with 3 partners. It shows how the profit gets split, first based on how much capital each put in, getting a percentage return on that, and then the rest is just divided equally among them. It really breaks down how you calculate each partner's individual income from the commercial operation.
Yeah, that OHG example does make it clearer how the individual incomes are worked out. There's another example, too, with a limited partnership, a KG. How does that differ?
The KD example is great because it highlights this concept of special operating income.
Special operating income.
Yeah. So In that scenario, one partner gets paid a salary for managing the KG. Another partner gets interest because they loaned money to the KG. And maybe the KG pays rent for a building owned by one of the partners.
Okay.
These payments, the salary, the interest, the rent, are treated as business expenses for the KG itself, so they reduce the partnership's overall taxable profit.
But they're income for the partners receiving them.
Precisely. Those amounts are then taxed as part of the individual partner's income from commercial operations. Dr. Yousefi specifically calls this special operating income, payments to partners that lower the company's profit but are taxable income for the partner. It's a really fundamental part of partnership taxation.
Right, got it. Business expense for one, taxable income for the other. What about the timing? When is this profit actually taxed, especially if the partnership's financial year is, say, July to June, not the calendar year?
Good question. Section 4A covers this. If a partnership's financial year differs from the calendar year, the rule is that the profit is considered earned in the calendar year in which that financial year ends.
Oh, okay.
Dr. Yousefi gives an example with Charlotte Geeson and Partner A to illustrate exactly how that timing works.
Okay. Now, something else mentioned is atypical silent partners. How are they different from just regular silent partners?
Right. So a typical silent partner usually just puts money in and shares in the profit or loss.
Yeah.
Their income is generally treated as income from capital assets. An atypical silent partner, though, is considered a co-entrepreneur under Section 15. Why? Because they don't just participate in the success or failure, they also participate in the company's assets, its underlying value. They have more skin in the game, essentially.
So it's about their stake in the actual business assets, not just the profit flow.
Exactly. That deeper connection, that co-entrepreneurial risk and stake in the assets is what makes them atypical and brings their income under Section 15, commercial operations.
That's a key difference. Now, this next bit sounds like a fairly major development. Partnerships having the option to be taxed like corporations. Can you unpack that?
Yes, this is relatively new. It came in with the Act to modernize corporate tax law. It allows partnerships, specifically OHGs and KGs, to choose to be taxed under the Corporation Tax Act, the KSTG. That's Section 1A of the KSTG.
And why would they do that?
The main driver mentioned is to help family-owned businesses, particularly, compete better internationally, level the playing field a bit with corporate structures elsewhere.
So instead of the partners paying income tax on their individual shares, the partnership itself pays corporation tax.
That's the core idea, yes. If they opt in, the partnership is treated, for income tax purposes, as if it were a separate legal entity, like a corporation.
How do they make that choice?
They have to apply. And there's a deadline. It needs to be submitted at least 1 month before the start of the financial year when they want the corporate tax treatment to begin.
And what are the tax results of flipping that switch?
Well, first, the partnership's profit is hit with corporation tax. Then, when profits are actually paid out to the partners, those distributions are taxed as income from capital assets under Section 20.
Okay.
And interestingly, if partners receive payments for working for the company, like a salary, that's then treated as income from employment under Section 19. So it really restructures how the money flows and gets taxed, both at the company level and for the individuals.
Wow. Yeah, that's a fundamental change. Can they switch back if they decide it wasn't the right move?
Yes, they can. Section 1A allows them to opt back out and return to being taxed under the normal partnership rules in the Income Tax Act. But again, they need to apply before the start of the relevant financial year.
Good to know it's not a one-way street. Okay, let's shift gears slightly. What happens when a commercial operation ends? Selling the business, Section 16. What does that cover?
Right. Section 16 deals with the disposal of a business. This covers selling the whole thing or just selling a distinct part of it, or even a partner selling their share in a partnership.
Okay.
And importantly, if you just decide to shut down the business, abandon it, that's treated as equivalent to a sale for tax purposes. That's Section 16, paragraph 3.
So whether you find a buyer or just lock the doors, the potential tax on any gain is handled similarly.
In terms of calculating and taxing the capital gain, yes. Any profit you make from selling or abandoning the business, the capital gain or disposal gain, is considered extraordinary income. That's Section 34.
And that
Means it might qualify for some tax relief. There's a potential allowance under Section 16 and possibly a reduced tax rate.
How do you actually calculate that gain?
It was basically the sale price minus the value of the business assets, which you figure out by taking assets minus liabilities, and then you also subtract any costs directly related to the sale itself.
Okay, sale price minus net asset value minus selling costs. Dr. Yousefi uses an example, Adnan Abbas. Can you walk us through that?
Sure. So Adnan sells his business for $250,000. The net value of his business assets is $85,000. He spends $5,000 on costs related to the sale.
Right.
So $250,000 minus $85,000 minus $5,000 gives a capital gain of $160,000. Now here's where the allowance comes in.
Okay.
If Adnan is over 55 or if he's permanently unable to work, he might be eligible for a special allowance under Section 16. The maximum is $45,000.
That's quite a bit.
It is. However, this allowance gets reduced if the capital gain goes over $136,000.
A phase out.
Exactly. Adnan's gain is 160,000 euros, which is 24,000 euros, over the 136,000 threshold. So his 45,000 allowance is reduced by that 24,000 excess. He still gets an allowance, just not the full amount. Dr. Yousefi shows the calculation with and without the allowance reduction, making it clear how much tax he'd save. It can be a significant benefit for people selling their business at retirement age, for instance.
That phase out is important to note. What about VAT? Is selling a whole business subject to VAT?
No, generally not. The sale of an entire business as a going concern is specifically exempt from VAT. That's under Section 1 of the VAT Act.
Good to know. And when does the tax point happen? Is it when the deal closes or when the cash actually changes hands?
The key date for tax purposes is the transfer of economic ownership, when the buyer effectively takes control, regardless of when the payment is fully made.
Right, economic ownership. Okay, that wraps up commercial operations nicely. Let's tackle our final category for today. Income from self-employment, Section 18 of the Income Tax Act. How does the law define self-employment?
Well, interestingly, the Income Tax Act doesn't actually give a single neat definition. Instead, Section 18 basically lists types of activities that count as either freelance work or other kinds of self-employed work.
So it defines by example.
Largely, yes. But drawing on court rulings and guidelines, we can say self-employment generally involves working independently, doing it sustainably, meaning on an ongoing basis, even if temporary, with the aim of making a profit, participating in the economy, and crucially, relying primarily on your own personal skills, effort, and expertise.
Okay, so independence and personal input are key themes. What are the main types of income here?
Section 18 breaks it down mainly into income from freelance work and income from other self-employed work.
Let's start with freelance. What falls under that?
Okay, freelance work, that's Section 18. Number 1 includes what are often called the catalog professions. Think doctors, lawyers, tax consultants, architects, engineers.
So classic professions.
Exactly. But it also includes similar independent activities that are scientific, artistic, literary, teaching, or educational in nature. And the list isn't closed.
Yeah.
It's not exhaustive.
Oh.
Right. Other professions can fit too, like midwives, massage therapists, even some IT consultants, depending on the specifics. The common thread is often a requirement for higher education or special creative talent and personal delivery of the service.
So quite a diverse group. What if a freelancer, say a lawyer, hires paralegals or other lawyers to help them? Does that push them out of self-employment?
Not necessarily. Section 18 actually states that someone in a liberal profession is still considered self-employed even if they use professionally trained staff.
Always provided.
Always.
Yeah.
Provided they continue to act in a managerial capacity and make independent decisions based on their own specialist knowledge, the core professional judgment and overall direction have to remain with them.
Right, so they have to be the guiding hand, using their own expertise, even with help.
Precisely. The ultimate responsibility and the key professional input need to rest with the individual freelancer. Dr. Yousefi gives the example of Dr. Franz Fabel, an internist. His profit from his medical practice is a clear case of income from freelance work.
Okay, and what about that other category mentioned under Section 18, other self-employed work? What fits there?
This category, under Section 18, number 3, catches roles like executors of wills, professional asset managers, think insolvency administrators, and also members of supervisory boards. These are typically people taking on specific roles or responsibilities independently, not as employees.
Got it. Now, we touched on this earlier, but the line between self-employment and a commercial operation can sometimes seem fuzzy. How do you tell them apart?
Yeah, Dr. Yousefi points out that the law itself doesn't give super clear dividing lines. It's often down to interpretation.
So how is it usually decided?
Well, based on case law from the Federal Fiscal Court, the key tends to be whether the work is predominantly shaped by the personality and personal expertise of the individual doing it. Are they independently involved in activities typical for that specific profession, using their unique skills? That points towards self-employment. Commercial operations often involve more capital, a larger organization, maybe more standardized processes.
So it's really about the centrality of the individual's personal professional contribution versus, say, running a larger system.
That's a good way to put it. It's about the personal touch and expertise being front and center.
Is there an example where this got tricky?
Dr. Yousefi mentions a really interesting case involving a tax representative. Now, normally tax advice is a freelance profession.
Right.
But in this specific case, the finance court in Düsseldorf decided the operation was actually a commercial enterprise. Why? Because of the sheer scale. They were handling something like 13,000 tax returns a year with 20 assistants. The court felt that at that volume, the individual tax agent couldn't possibly be exercising that necessary managerial oversight and independent professional judgment on every case. It had become more like managing a large processing operation.
So the scale tipped it over.
It seems so. And the consequence was significant. The income was then subject not just to income tax, but also to trade tax, which is typically levied on commercial businesses.
That really drives home how the nature and scale of the operation, even within a traditional profession, can shift the classification.
Absolutely. It comes back to that core principle for freelance work. The professional has to be acting in that leading managerial role based on their own specialist knowledge, even if they have people helping them.
Well, we have definitely covered a huge amount of detail today. We've dug into agriculture and forestry income, commercial operations, and self-employment. If you had to boil it down, what are the absolute key takeaways for our listeners?
I think the main thing is to grasp the core identity of each category: agriculture and forestry. Fundamentally about using natural resources in a planned way. Commercial operations, that's your ongoing business activity, independent, aiming for profit, participating in the market but not fitting the other two. And self-employment, that really hinges on independence, personal effort, and often specialized skills or knowledge being the primary driver.
So recognizing those fundamental characteristics is step one.
Exactly. Understanding those core differences is really the foundation for navigating how different ways of earning money are treated, especially when it comes to tax.
Absolutely. And it's clear that while we have these categories, the specifics of each situation, the individual circumstances, really do matter a lot. So as we wrap up this deep dive, maybe a final thought for everyone listening. Considering how work is changing, the rise of the digital economy, the gig economy, platforms blurring lines between employment and contracting, how might these traditional classifications of income need to adapt or evolve in the future? What could that mean for taxation, for the economy, as these neat boxes potentially become less clear-cut?
That's a fascinating question. Definitely something to keep an eye on.
It certainly is. Thanks for joining us on the Deep Dive.